Hello friends, welcome to my YouTube channel Microfinance. In this particular channel, we will be talking about various aspects related to microfinance. But before going deeper into other concepts related to microfinance, let's understand in basic term what actually microfinance is. As you can see, microfinance is made up of two words, micro and finance. Micro in layman language simply means something which is very small. And finance, as we all are aware, that it is a money required to start any sort of business. And if we relate these two terms, we will come to know, we will arrive at a basic definition of microfinance, which is basically a finance which is provided to poor people who wants to start their own business or any sort of work, income generating activity. Micro is basically related to here micro entrepreneurs, self-employed people, low income population, and finance means business and educational loans, savings, another which is given to low income population. Now, now let's move on to the definition given by various financial institutions. In this definition, I have selected to show you the definition given by Asian Development Bank. The Asian Development Bank defines microfinance as the provision of broad range of services such as savings, deposits, loans, payment services, money transfers, and insurance to poor and low income households and their micro enterprises. So you can see that microfinance is just not the provision of loans, but it covers a wide range of financial services like savings, deposits, loans, payment services, money transfer, and insurance to poor and low income household. And this definition covers basically not only people who are residing below poverty line, but it also includes people who have low income households. So we can basically understand that microfinance is a concept that helps the poor to avail and create opportunities for economic growth. And in India, if we say microfinance has fueled the efforts of rural development, women empowerment, and wealth generation by providing small scale savings, credit insurance, and other financial services to poor and low income households. Here we can say in a summarized form, microfinance thus serves as a means to empower the poor and provide a valuable tool to help the economic development process. People are often confused that now let's come to a very basic concept which is often confusing sometimes. The term microfinance is often confused with the related term microcredit as the two are treated as synonyms and used interchangeably. While there are certain similarities between the two terms, there are also certain differences which require to be clarifying at the very start to avoid confusion of any type. The term microcredit basically refers to small size loan provided for a short period of time, used mostly low income households and micro entrepreneurs for the purpose of income generation and enterprise development. While microfinance, on the other hand, it provides a greater menu of options whereby the small loan can be collected not just from the external sources but also through self mobilization by way of savings and sale of assets. In case of microcredit, due to the definite compulsion to repay the loan, physical collateral may sometimes be required. But in case of microfinance, we can observe there is a flexibility if there is absence of any physical collateral, even in the case of loan from bank. The options available with microfinance therefore are much broader and flexible than the ones available with the microcredit. Microcredit in a layman term, you can say it specifically refers to availing the credit facility only. But microfinance is a broad range of financial services provided to the poor people. Let's throw some light on the history of microfinance. When we talk about microfinance, there's only one renowned name comes into our mind, that is Professor Muhammad Yunus. Microfinance began as a radical experiment, the brainchild of Bangladeshi economist Muhammad Yunus. In 1976, while teaching at Chittagong University, he surveyed the nearby slum community of Jobra for opportunities to help the disadvantaged. Basically, Professor Muhammad Yunus was of a mindset that never give charity to poor, give them means to survive. And with this principle, he came to a concept of microfinance whereby Yunus drew unexpected insights that would compel him to open up Grameen Bank, the first microfinance institution. Before the Grameen Bank came into existence, low income villagers in Jobra had no opportunity to obtain credit. First of all, they had no means of physically reaching a conventional bank. Even if they did have affordable transportation, banks would never make loans to people without assets or a credit history. The only alternative available to the Jobra villagers was to use local money lenders who would charge exorbitant interest rates. Yunus was driven by the conviction that poor were not fundamentally unworthy of credit. The people he knew in Jobra managed their household responsibly. Yunus reasoned that poor were lacking in resources but not in trustworthiness or financial sensibility. He believed that they would be able and inclined to honor loans if only given a reasonable interest rate. This belief lay at the heart of Grameen Bank's business model. An important part of Grameen Bank's revolutionary model has become known as solidarity group lending. Yunus pioneered this innovative concept. He recognized we can say that he recognized that dividing a loan among several recipients could reduce transaction cost. Additionally, collective lending served as a near guarantee that loans would be repaid on time. Not only group members enabled to cover if need to be for each other's installments, they would also be penalized if any of one of them defaulted. The resulting social pressures created as a check against free riding and delinquency. This joint distribution method was essentially limited to women, a stipulation created by Eunice. He felt that women were more reliable, typically at fulfilling their payment obligations and cooperating with their peers. Besides sensing that women would overwhelmingly invest in their families' well being, Yunus recognized that they faced greater obstacle to improving their financial circumstances. Grameen Bank has continued to help marginalized women as it expands throughout Bangladesh and around the world. Now, let's come to the basic features of microfinance. What is the first feature? First feature is the borrowers do not need to provide collateral. The basic feature of microloans under microfinance is that it does not require any collateral. The borrowers can avail of a microloan without providing any security to the financial institutions. Second feature, it is offered to low income individuals, which means the purpose of microfinance is to uplift needy and low income individuals who contribute to the economy. It is an opportunity for needy people to escape poverty. Therefore, microfinance is generally offered to people from rural and underdeveloped areas, small business, and needy women. Third feature is it offers small amount loans. Since microloans are offered without any collateral and the borrowers are generally low income people, the loan amount is usually very small. In India, the financial institutions typically offer microcredit or microloan amounting to rupees 20,000 to 30,000. Fourth feature is it has a short loan tenure. As the loan amount is very small, the loan tenure offered for microcredit is also short. Although they do not provide any collateral to the financial institutions, they have to repay the loan within the prescribed time period which is given by the financial institution. Fourth feature is the purpose is to uplift the poor people. Microfinance is an economic tool for financial inclusion in the country that focuses on the poor sections of the society to let them put their ideas into reality and generate income opportunities for them. It also ensures that low income individuals outgrow small loans and become a part of conventional banks. Microfinance products. In the microfinance sector, there are other services expanding as well. The poor need, like all of us, a secure place to save their money and access to insurance for their homes, business, and wealth. Microfinance institutions are now innovating new products to help meet these needs, empowering the world's poor to improve their own lives. Products common used in microfinance sector today are: first is micro savings, a possibility to save money without no minimum balance, allows people to retain money for future use or for unexpected costs. In self help groups, the members save smaller amounts of money, as little as few rupees a month, in a group fund. Members may borrow from the group fund for a variety of purposes ranging from household emergencies to school fees. As self help groups prove capable of managing their funds well, they may borrow from a local bank to invest in small business or farm activities. Banks typically lend up to 4 rupees for every rupee in the group fund. Next is microinsurance. Microinsurance, this is basically the IRDA Microinsurance Regulation 2005 defines and enables microinsurance. A microinsurance policy is a general or life insurance policy with a sum assured of rupees 50,000 or less. It gives the entrepreneurs the chance to focus more on their core business, which drastically reduces the risk affecting their property, health, or working possibilities. Next is microleasing. For entrepreneurs or small business who can't afford buy at full cost, they can instead lease equipment, agricultural machinery or vehicles, often no limitations of minimum cost of the leased object. Next is money transfer, a service for transferring money mainly overseas to family or friends. Money transfers without opening current accounts are performed by a number of commercial banks through international money transfer systems such as Western Union, MoneyGram, and Anelic. On the surface, they may seem like small money transfers, but when one considers that such transactions take place millions of times around the world each week, the numbers start to become impressive. According to the World Bank, the annual global markets for remittances, money transferred home from migrant workers, is around 167 billion US dollars. The estimated total is closer to $230 billion if one counts unregulated transactions. Remittances are also an important source of income for many developing countries, including India, China, and Mexico, all of which receive over $20 billion each year in remittances from abroad.